All right. So, well, it would be a little bit easy to say another weird week because at the end of the day, when something happens week after week for most of the month of June, you can't really say that it's weird anymore. I think it was weird first Friday, and in fact, it was probably a bit of a signal, even though the way again it went down on that Friday, the 6th, I want to say. Was a bit particular because you had a large move down with very little realized volatility throughout the day. But then throughout the month overall, you have had a decent bit of realized volatility and at the same time, some expansion on the implied side, but nothing insane either. Right, so we'll talk at length about realized today, but let's start as usual with where implied stands. VIX closed at somewhere like 18, 18 and a half. So if you take the last 9 months as a reference for some sort of like new regime, even though there was definitely some regime between that period, that's pretty much right in the middle of the range. Nothing special, 50th percentile. If you look at the very wide distribution since 2004, definitely somewhere in the middle of the range. The long-term average in VIX is somewhere around here, whether you look at median average, slightly different, but overall it's like it's nothing special. We are at 18, these things happen. It's just the way that we are at 18 that are very different from when we were at 18 not longer than month of May when things were perfectly quiet. And again, realized volatility was much lower. We'll speak about that in a second. The other big characteristic is the last 10 months. When VIX was at 18, you would have seen VVIX at 100 at least, right? If you just compare, this is your 50th percentile here. Your 50th percentile in VVIX is right around 98, 100. That was one of the big characteristic of, again, the last year or so. People were buying a lot of VIX calls. And at the close on Friday, despite the market moving quite a bit, VVIX is at 90. So once again, you don't want to draw definite conclusion, but it's a market that used to buy VIX calls in anticipation for movement, as like, if something happens, I want to be hedged somewhere, and the way I want to be hedged is through potential VIX expansion. That's not the case anymore. The reason why it's paradoxal, or at least interesting, is realized volatility is much higher than most of what it was for, I mean, since May 2025, right? It cooled down after Liberation Day, obviously. It got stuck at around 10 for the longest part of summer last year, starting to climb again somewhere in October. And then 2026 is something a bit different. But during that entire period, up until March this year, April this year, you would have had a VVIX at 100 and more. And now we're starting H2 2026 with people saying, I don't really care about owning VIX calls in my book. Just get me out of that stuff. You don't want to, there's too many potential reasons that explains that, right? It doesn't mean all of a sudden the market is oblivious to risk. It could also mean simply those VIX scores, they are arguably one of the most expensive insurance in the market. And the market realized that, like, okay, well, we have had a big spike in VIX. In April 2025, we had a bit of a spike during the Iranian crisis, but nothing crazy. And then people recalibrate their views of risk, their understanding of risk, and they're like, why am I keep paying for something that's not really materializing itself? So it's again like it's good to have a few reason. It's a game of playing with incomplete information. It's good to have a few reason in mind to get a feel for what's happening, but you also don't want to be married to one perspective and be for sure this is what's happening at the moment. All we want to do though is remark that yeah, it's definitely different from what it used to be, and therefore you probably need to adapt your trading or at least the kind of data that you're looking at. Um, Data that we're looking at though, and today we're going to talk a lot about Realize. I mean, we talk mostly about VRP here at Sharp2, but today the focus is going to be on Realize because again, Realize has been, I don't want to say acting out, but at the very least, it's at a place end of June where I'm not saying it was not supposed to be there, but it's high, right? Like again, you look at realized volatility in SPY since end of 2023. It's not too often that you see it above 15 in SPY. It's definitely not too often that you see it at 17. What happened in June? It's hard to tell, right? I can tell you a story about what happened here. It's pretty obvious. Iran, Iran war. Here, it still went to 15, but it was mostly the stuff around AI. Okay, this one is pretty obvious. This one everybody remembers as well. And this is a long time ago, but you had the premise of Israel and Iran war at that moment. Here, is it AI narrative? Is it still Trump and Iran and all of that narrative moving the markets? It's definitely not as clear as day as most of those last clear spike, even though some are real spikes and some of them are just realized going up. This one is not as clear as day. It's much harder to understand exactly what's been happening. Um, I hinted at it in the newsletter, and the reason why it started to get at a level where we want to pay attention to it, and I also mentioned that when we were there in the peak of the oil crisis this year, a lot of fund managers basically manage their fund through volatility targeting. And when realized volatility gets too high, it's pretty simple. You get a call from risk managers, compliance that says, well, in our mandate, we say X, Y, and Z, and here is the number. You have to take action about it. And therefore, sometimes that can create extra selling in the marketplace. So don't take that as a reason to believe that all of a sudden every fund manager on the planet is going to come up and just sell all of their stuff and then tomorrow we lose 20%. That's absolutely not what I'm saying. But if people keep selling, basically you basically kind of have enough oil in the engine for that realized volatility to stick around, right? Like as long as people are going to sell stuff, that can just fuel itself. Which for us, obviously, we trade VRP is not necessarily a great news. That's a number that I would like to see lower. It's a number that I was expecting to see much lower. And especially when we head into summer, right? It's been 2 weeks that I was kind of dodging that prediction, saying that like, yeah, I mean, I know how that model is working, and maybe it's wrong, and maybe we're definitely not seeing anything above 15. 2, 3 weeks ago, I was already pointing much higher than that. Well, it turns out that the prediction is at least on track, right? If we compare to two weeks ago, it was definitely pointing at above 15. We're above 15 right now. Now it's saying 20. You don't want to keep dodging a model to kind of fit what you want to see. At that stage, I would like to see a very lazy summer, very similar to last year, where I realized volatility is at 8 and you can sell VIX at 15, 16 and just go to the beach. But right now, that's not exactly where we are, and it doesn't look like there's no obvious sign that this is where we're heading. And I've talked so much about that lazy summer that now I also have to like, yeah, make um, not warnings, but at least, yeah, bring people to realize that like, yeah, like the scenario we've been talking about for a while, yeah, it's not as clear as day. It's not as clear as a month ago when we were here, and clearly nothing was happening. And for again, kind of an obscure reason, things went up for quite a bit. So ideal scenario in the next 2, 3 days, 4th of July is around the corner. Things cool down again. and hopefully they cool down for a decent bit of the summer. But if they don't, what do we do? We're going to talk about VRP a little bit longer after we finish talking about Realize, but yeah, like what do we do? It's pretty obvious right now. Let's start with, let me restate the obvious because I know that people love to trade zero DTs and stuff. You don't have a strong hedge in there. I mean, then if you play it directionally, it's different, obviously. If you have an edge on direction, then you may not even need to listen to the kind of stuff I talk about. But if you just sell straddles, strongholds, induce DTs these days, and I mean, I'm pretty sure that some of you are, if you trade zero DTs or short dated stuff, you look at some of the gap down that you have. Some mornings you're down 1%. You know, if you have a zero DT, you wake up in the morning. It's sometimes it's a bit painful, right? And then you try to readjust the next morning at the open. It's on the other side. It hasn't been too easy, I believe, if you were here. But before getting longer into the VRP, let's switch to the other one that's really interesting. So this one was SPY, right? SPY realized vol at 17. The Qs has realized vol at 30 at the moment. And this one is a bit puzzling. So obviously, so we doubled, right? Literally in about 6 weeks, a little bit less than 6 weeks actually. Well, yeah, because early June we were at 16, so literally 4 weeks we doubled. Same idea, you can't really say that there is something new, right? Obviously, there's a little bit of narrative around AI. There was the SpaceX IPO, and supposedly people were selling some of the tech stuff to get liquidity so that they could reinvest in SpaceX. Kind of makes sense, but now the SpaceX IPO is behind us. It's still end of H2, so you can say that maybe people are still rotating from some position to others. There's some legs to that. If you look at the performance of Max 7, it's actually pretty nasty this month, and the rest of tech is not necessarily as bad. But in any case, I go back to the argument I was making about vol targeted fund. It's really high in the queues right now, and it's high enough for something. Um, I don't want my what I'm saying to be misinterpreted, but it's start to be bad enough for something to snap, right? Like when you're above 30, once again, you look at that chart, it's moving quite a bit. It can keep moving up, by the way. It doesn't give any sign right now that it's going to slow down, but like where could it snap from? There's a lot of ultra leverage ETFs, for instance, in the semis. Let's say that one fund, everybody, I guess, remember Vormageddon, this kind of stuff. I'm not saying this is what's going to happen, but we start to arrive at certain level of risk and movement in the marketplace that are abnormal, and therefore a lot of product that in normal circumstances behave normally. Well, we are not exactly normal circumstances, even though, and that's really it's quite a contrast with the kind of videos I made the last few weeks, right? Because on the surface, again, like stuff are VIX 18, it's okay. There's nothing fundamentally broken, right? It's not a red alert. Be very careful. Big tsunamis arriving, but realize vol at 30 in the queues is not exactly normal, and you don't want to shrug it away and say, oh yeah, I mean, it's going to come down and it's okay. It's just transitory or whatever. What if it's not? And what if next week, despite 4th of July, we're at 36, 37? Then what's the consequences on a lot of different moving pieces that makes the market what it is? So yeah, like that's really the one I wanted to talk about quite a bit. I mean, I wrote about it in the newsletter. I think that number is interesting. It's interesting enough for us to spend a little bit of time on it, and to understand that, or at least get really clear in the mind that despite things looking fairly normal on the surface, there's a few stuff that are worth paying attention to so that we're not being caught completely by surprise. Um, as I was saying also in the newsletter, though, And that's the flip side, because if you just listen to this, you're gonna say, and again, I insist, don't go short uh 20x the Qs thinking, oh, Alex said that and stocks are going to go down. Absolutely not. Realize can be high and stocks not go down. It happens. It's possible. The silver lining is whether it's the Qs or SPY, the risk around insurance, so vol of vol, right? Volatility of implied volatility. So if you consider that realized volatility in the stock is basically the measure of risk of owning the stock, right? You can take 10%, you can lose 10%. Depending on realized volatility, the probability of taking 10% or losing 10% is completely different. I don't have the number at the top of my head, but the probability of losing 10% when you are at 30% of realized vol at 30 days, I want to say that it's significantly higher than here. And I don't exactly remember the numbers, but I also know that you can't simply multiply by two. I want to say you want to multiply by four or five, and here it's probably somewhere like 2%. So yeah, now it's more 15%, losing 10% over a week, right? Not in one session. We can do the math in the Discord group. So yeah, like just keep that in mind. The likelihood that we take 10% or that we lose 10% is quite high. This is the same with implied volatility. So it's basically, if you want to build some intuition around it, it's the risk associated with insurance contract, right? Options are nothing else than insurance contract. Um, and you can understand that the risk of owning a stock is X because stocks are moving all the time. But the risk around owning an insurance contract to me is much more interesting because it gives you an idea of really how stressed the marketplace is. This one already tells you that the market place is probably a little bit stressed. But if you see a lot of volatility in owning an insurance contract, it's usually not a great sign, right? Like again, if you look at that chart historically, when you have big charts, well, that when you have big spikes, that happens when the market becomes quite stressed very quickly. April, Liberation Day. Last year it was high, but never got crazy. Sorry, this year during the Iran oil crisis was high, but never completely crazy. And so far, we are mid-range, right? So it's a market where realize is moving quite a bit, realized volatility is moving quite a bit, but realized volatility of implied volatility is somewhat normal, right? So it's a bit again of a paradox where, well, the underlying is moving a lot, but the price of insurance is not moving a lot. Okay. So normally, again, if you want to if you play with incomplete information, you could conclude, I don't think it's far-fetched to conclude that, okay, like it's the end of the semester and people are rotating from different position. And obviously when you rotate portfolios, that create volatility, right? All the time. Um, but it's not to the point yet where the market start to get really concerned and rushes into hedges because they're scared about what could happen to the value of their assets, and then the next day they just decide to dump everything because, um, well, like the marketplace is just tense and stressed, and you don't want to own those insurance now, and yeah, like that's what happens when vol of vol is really high. Having 4 or 5 points of VIX within one day, sometimes within a few hours, is something very typical. If you go replay a few of those sessions here, you would see 24 in the morning and then 29, 20, 29, almost 30 in right before the close, right? 6 points of VIX within a day. Normally, that's not a feature when you're here. You would need to see it much, much higher. So, right, no, basically the way I'm looking at this is I give all of that, no, I don't want to say the benefit of the doubt, but yeah, you look at vol of vol in SPY, it's still not alarming. This one is not alarming, but this one, yeah, it makes me slightly uncomfortable. It's not, I mean, clearly, right? You don't need to be an advanced mathematician to see that that number is not completely normal. So now, how do we trade that? Um, well, the same way, right? Again, I don't think it's rocket science. In yellow, you have your realized vol. In SPY, your VRP is pretty much flat or negative for most part of the front curve, right? Up until 3 weeks. If you look at the Qs, it's probably even more pronounced. So even at 30 days, it's slightly negative. So do you really want to be selling options here? I don't think so. And if you have positions here, it's fine to take them and then put them somewhere in September, where so far there's much higher VRP in those options, and then give it enough time, right? But it's a funny situation where realized has come up quite a bit, and the VRP term structure is very skewed to the negative, where it actually paid money to own gamma, especially in the very short dated options. Uh, and the very comfortable 30 DT strongholds that we've been selling consistently for most of 2026, and again, a big chunk of 2025, as it is less and less comfortable, right? It's not so long ago that I used to say, well, you have 5, 6 point VRP at 30 days in SPY or in the Qs. Right now, you absolutely do not have 5 points. You have something like, let's see, yeah, you have about 3 points in the VAR swap at 30 days. That's not a lot. That's even less a lot when realized start at 16. The other thing that is important, I was explaining that during the Iranian oil crisis, and I'm going to reiterate on this. The other big difference at RV16 versus RV10 is the risk of jump. So 3 points VRP at 16 or 3 points VRP at 10, the real risk that you have is the market can lose 1-2% overnight, and all of a sudden your position is basically being challenged for a lot of reasons. You can't even delta hedge. If you tell me about delta hedging and all that stuff, you can't do that overnight. I mean, it's much more complicated. So yeah, like it's not great these days, right? Like I think we start to get to a moment where and it sucks because it's before the summer, and usually summer you really want to have a lot of position, but we start to be at a crossroad where, okay, let's see how this week goes, and maybe everything relax and everything becomes much easier to trade with much clearer VRP signs. But I think it start to be at a point where I'm not saying you shouldn't trade, especially because you still have decent probabilities, I think, for most of those. But I think it's one of those situations where you want to at least be very careful or much more cautious with the amount of risk you put on the table. And if you have to pick one, I think we put that one in the Discord this last week. The diamonds tend to be a little bit more stable, so you can see RV is usually much lower than the counterparts. Um, but you want to be careful with the Qs and also with SPY, because you still have Nvidias and Teslas and all that stuff. I think in the diamonds, the big one really is Microsoft. From what I remember, you might have IBM and a few of those ones. But yeah, like if you have to pick where you will take VRP in US equities, in the indices, this is the moment where you say Qs, yeah, why not? But you don't have to be all in those, even though the numbers is 64. It's respectable. It's not amazing, but I would understand why someone take that trade. But again, realize is high, and there are better opportunities. So essentially, you probably want to get a little bit of risk, give it a week or two to see how risk evolve over the next 2 weeks, and if it's worth going back into that trade. But otherwise, you have alternative, and I think this one is probably a little bit safer at the moment. Whatever you want to say behind safe, if we have a look at it very quickly. So it's funny because the diamonds, when I started my career, everybody was talking about the Dow Jones Index, but now it has lost all of his loss. Nobody really talks about that one. So same idea, right? Like it's still expecting realize to go up. The VRP is much smaller in the diamonds, but you still have at least something around here. You don't need to go 3 months out like the Qs or SPY at the moment. The regime is much clearer. It's been in positive VRP regime for quite a bit, but same idea as the other counterpart, right? We went from 12 to 15, which for the diamonds is, like 15 is not, it's not high, but it's not exactly low either. If you look at the last uh, the last um, the last 2 years. So that's the story of US equities at the moment. It's extreme in the Qs. You can observe the phenomenon in the other indices. It's interesting enough for us to pay attention to it because ultimately we make money out of options being overpriced in regard to realized volatility. And at the moment, yeah, it's giving a few signs that are like respectable enough for us to listen, right? I'll conclude on this one, but yeah, this is not exactly normal. If you guys have questions, I'm happy to uh, I'm
Yeah,
happy to answer.
Alex. Hi, Alex. I trade the Dow futures quite pretty much every day, regularly, and as day trading. But yeah, I just want to remind you that the Dow is actually a price weighted index. So I don't know where Microsoft is in that, but I can tell you that the top weighted stocks in that are, if I remember correctly, Goldman Sachs and Caterpillar. So not exactly.
Yeah, yeah. I mean, it's a yeah. That's yeah, yeah. That's a great insight. At the end of the day, the Dow is overall way less exposed to tech stuff than the Qs for obvious reason. But even SPY, right? SPY has quite quite some heavy tech names in there, and that's going to have a big impact on how the index is going to behave. If I remember correctly, I think there is some stories of SpaceX getting into the queues very quickly and potentially inside SPY, maybe at the turn of the month. I don't exactly remember the rules. I seem to
Yeah,
recall that there was some rules bending anyway.
Nasdaq. Yeah,
So
SpaceX goes to Nasdaq. I think is it the 7th or something of July, something like that.
yeah,
I don't.
yeah. So you already have you already have RV at 30. SpaceX is about to get in. You don't have to trade is one of the rules that people tend to forget. At Q's 30, it's tempting. You'll see like really high IV rank, all that stuff. Anyway, that's not the kind of stuff we look into anyway. In the platform, you'll see this and you'll be thinking, okay, it's not that bad. Yeah, it's not that bad, but RV is really high right now, and that's why I insist on it. Yeah, you can be on the sideline and watch, and you can trade all the stuff. It's okay. Don't have FOMO. Other questions or remarks?
I've been making a lot of mistakes in trading the overnight DTEs and zero DTEs and presumably.
Normally I'm releasing a model for that soon.
Okay.
I have done a little. I mean, I think that I wrote that article 2 years ago,
Yeah.
which at the time was. I mean, it's actually interesting because I wrote two articles back to back. I wrote the one about when VVIX is above 100, you probably want to be short overnight, and then right after that, I wrote something that in my mind was much more promising, which basically used to say if realize a spike not too long ago, then you probably it's gonna cool off, and therefore you probably want to short 1DT overnight, literally overnight, right? I also see some of you keep it in my mind a little bit too long, right? You enter at like the close and you get out before the close or right at the close, but don't keep it too long throughout the session because then it's another trade. But anyway, so it's gonna be based on that. It's an old article that's still on the Substack, I think, and the Sharp is quite decent, 2.5 over the last few years. So I'm releasing this. Normally I'll put it into the API. I think I'll put it in the Discord as an alert in the channel so that people can see that okay, that's probably good timing to get into that trade or it's not. And yeah, and I have good data to back it up. So hopefully less mistakes on the 1DT stuff.
Did you say that is that article?
It's definitely on Substack.
Can you post it?
Yeah, I'll dig into Substack and put it into the Discord after the call.
All right, thank you for
No
that.
worries.
Yeah.
Well, if no other questions, then I wish you guys a good night, a good evening, or good afternoon, and I speak to you all on Discord.
Thanks, Alex.
Thanks, Alex. Thanks,
Thank-
Bye,
guys.
guys.
Thanks,
Cheers.
Alex. Bye.